let's make sure before we just start talking.
Sure, right.
Right. So instead, assume we're on right now, but let's make sure.
Yeah.
All right. So we're going to go ahead and, are you kidding me? We're going to go ahead and, that'd be my phone ringing that I can't reach right now. So we are going to have a little chat today. I'm here with my friend Bo Caldwell. Bo is the owner and president of Price Financial Group.
Yep.
Price Financial Group. Sorry, that's going to stop any second. Hold on. Let's just hang out and wait.
I don't hear it, if that makes you feel any better.
What was that?
I said I don't hear it.
Oh, you don't? Okay, good. It's actually like ringing through my computer. So everybody else can hear it right now, I'm guessing, which is really lame. So I'm going to put that all on mute so that we can actually have this conversation. And we will go from there. Okay, so I'm here with my friend Bo Caldwell. Bo is a certified financial planner, which is a really big deal. That's what you want. That's what most of the industry, it's a designation that not very many people in the industry actually have. He's been doing financial planning for almost a decade. He has helped my own family with financial planning. This is what he does. It's what he lives, eats, breathes, all of those things. When he's not taking care of his family and doing all of that, this is what he does. So I asked Bo to jump on here today with me to chat about financial planning, because as all of this chaos, and even when I asked him to do it last week, the world has changed even more over the last week. So we're just going to have a candid conversation about what do we do with our money, what happened to our money, that if it was somewhere else. Bo, is my 401k safe?
That's kind of a loaded question, and the answer.
I know they're all going to be loaded questions for you.
No, that's okay. So depending on, you have to put the caveat out there that I don't know where everyone's
you don't know everybody's 401k
invested in, but unless it's in what's called the stable value fund inside of your 401k or in cash, then it has some form of risk, which is what you're going for with a 401k, though, right? Is you're trying to earn money, because cash doesn't make very much money right now. The only thing that is quote unquote safe or not at risk would be cash or CDs, right? Which are FDIC insured, but those earn about 0.25% a year if you're lucky. So you're barely keeping up with inflation, if at all, or you're losing money to inflation, right? So the short answer is no, your 401k is not safe, but that comes with a caveat. It doesn't mean you should be panicking and running to the 401k and moving it all to cash right now, because invariably the market's down. We're down about 1,000 points in the Dow Jones today, which sounds like a huge number, and it is 4.5% down today. And since February 20th, which was when the peak in the market was, we're down almost 35% in terms of an overall dip, which is a lot, right? So it makes people think of 2008. Back in 2008, when the market went 57% from peak to trough, peak being the high in the market, and then when it hit the bottom. But interestingly enough, the people that got hurt the worst in that 2008 financial crisis, which is totally different than now, right? Because we're in a health crisis, not a financial crisis. We're the people that sold near the bottom and then never got back in. So even if you bought at the exact wrong time, you started your 401k right when the market peaked in 2008 and just held on, then you more than tripled your money since then, right? Okay. So if that makes sense, it's kind of like kind of like thinking about when people are talking about buying a house, right? When they think about, well, the market's really high, eventually, even if the market dips, it comes back, right? With the housing market. I mean, that's your expertise, not mine. But similarly, if you're investing in your 401k, you're investing for 5, 10, 15, 20 years down the road, not investing for tomorrow, right? So the short-term volatility is going to be dangerous, it's going to be scary, and it's not safe per se. But if you're invested in high quality, companies, if you're invested in high quality investments, eventually, I have to believe that it'll come back.
So real estate, we can look historically and see how the cycles, and we can actually say that we know that we rise and fall in about a 10-year cycle. Does stock market? Okay, let me be really honest.
Sure.
My husband does all my money. My job is to make money. That's what he tells me. You go make money and I will figure out where to put it. So my husband does my money. Does the stock market have those same cycles? Like, is there, like, historically, is there data that you can follow? And if so, I guess my question is, if I have money in things right now, obviously I want to leave them there. I don't want to yank out at the bottom or closer to the bottom. What kind of cycle is that, as far as in real estate? I say, if you're going to live there for 5 years, you're going to be fine. If you're planning on selling tomorrow, you might have a problem.
Right. Yeah. So the short answer is yes. Historically, there are market cycles. You hear the term bear market, bull market. A lot of people will throw those around, and those are technical terms that have just been created based upon the upward movement or downward movement in a market. But historically speaking, similarly, you're talking about if you're going to live in a house for 5 years, if the money is going to be something that you're not looking to use for 5 or 10 years down the road, then yes, I have extreme confidence. Now, the difference, like you said, I know only as much as history has done, right? History doesn't repeat itself, but it rhymes, right? So the idea being, here's kind of what we've gone through in the past. And once every 10 years or so, give or take once a decade, we have an event similar to this. 2008 was a little over 10 years ago. The dot-com bubble was, around 10 years before that. The 1994, when we had the interest rate spike, was right before that. You go about 1987, when the stock market had Black Monday, where it lost 25% in a day, right? Not 25% over a couple of weeks or a month, but in a day. But invariably, it always has come back. Historically speaking, when we have markets like we've had over the last month and a half, not only does the market come back, it comes back and reaches new highs. And average time usually takes between 3 and 5 years to get back to that level. Now, the difference between those that I just mentioned and what we're experiencing now is that this isn't a fundamental financial crisis, right? So it's not like what happened in 2008, when we had bad loans being written, when we had banks insuring those bad loans, all the different things. If you've watched the movie that was it Adam McKay, the Big Short, right? You see all the things with the Big Short. That's a really good movie to watch about what happened in 2008. This is because the government's basically told us to stay home. You're in your house, in your room right now. I'm in my office all by myself, because we're practicing the social distancing, right? We're trying to flatten the curve on the coronavirus. But it wasn't a situation. Oh, that's my phone's doing that. Sorry.
Okay, good. So I just looked at mine. I was like, it's not mine.
No. But the difference is, this isn't caused by anything wrong fundamentally. Our economy has been really, really strong. In 2008, banks had way too many bad loans. They didn't have enough cash sitting on the sideline. Right now, the banking system is super strong, right?
Right. I mean, you're seeing the same thing we're seeing, where it's like, this is unprecedented. Of like, we don't really have a financial crisis right now. We have a health issue, and it's. I guess in real estate, we're talking about how we go up this big steep curve, we hit the top, and then we come back down. We're looking at it more of being a V bounce back up than back to the same U, right? So it sounds like financial is feeling. Obviously, we don't have a crystal ball. If we did, we'd have millions. Well, you manage millions, but you manage millions. I sell $1 million homes, but we would have millions if we had our own crystal ball. So my biggest question for people that are watching, and for myself, is what do we do now? What is the thing that we should be doing with our money? What do we do? And if we have money that was sitting in savings, is now the time to invest it? What do we do?
So in terms of the first part, when you're asking about what do we do, so you mentioned 401k, so a lot of people watching probably they're investing in their 401k, and the key is, if you've been on this roller coaster, don't get off the roller coaster in the middle of the ride, right? So it's doing this, it's going up and down. You maybe need to meet with a financial professional and analyze your tolerance for the roller coaster, because some people like to ride the Matterhorn, and some people are Mr. Toad's Wild Ride or teacup type people, right? And so if you're a teacup person and you've been riding the Matterhorn, then maybe you need to make a change, because now, having gone through this, which historically this is going to happen again at least once every 10 years. Usually it happens multiple times in terms of big fluctuations in the market. That you need to make sure that your roller coaster is built out for you. But if you're plugging money away every 2 weeks out of your paycheck, if you're lucky enough to not have been furloughed, or you're still working and still participating in your 401k, don't stop. You may want to decide, where you're going to allocate a little bit differently. But if you think about when the market does these giant dips, you're buying on sale. If I told you, Jen, that you could go out and say, hey, look, all the houses that the listings that you're looking to, pick up for your clients that are looking to buy a house, were 30% off, right?
Yeah.
With 40% off, you'd be like, well, let's buy 5, right? Because they're 40% off. And we know that historically they're going to come back. So you're buying it on sale. If you have money sitting on the sidelines, is different. I don't know that now is the exact right time to just, throw all your cash to work. I especially wouldn't recommend I've had people ask, should I take out a home equity line and go buy it in the market? No, right? I don't think you should be borrowing money to then invest money, right? But if you have cash that hasn't been put to work, there are good opportunities out there. And I would encourage people to meet with your financial advisor if they have one they're working with, meet with a professional to talk about what opportunities might be there, because you can get some quality companies out there that are super strong, that have good balance sheets. But even if you're doing that, I'd recommend a strategy called dollar cost averaging. Okay. And that means over the next weeks or months, you're putting in a certain amount every week or every month, rather than trying to time it all at once, because I think that we still have more downward pressure to go before we start to really come up. You mentioned a V-shaped recovery. We're looking at more of hopefully a U-shape, hopefully not an L-shape, right? Because what's going to happen is the market's still digesting the coronavirus epidemic. We've seen cases possibly peak in Italy. It seems that they've peaked pretty well in Asia. Hopefully we're not too far behind where we can get the number of cases to peak in our country and start to get people back to work. But unfortunately right now we don't know when that's going to happen, and the market's still trying to digest that. And so I think what that means, at least in the short term, the next month or two, it's going to be a lot of this. And so a lot of times what people will happen, and I have, this is I can't think of the word right now. Dr. Fauci talks about it all the time, but it's anecdotal. Thank you. It's anecdotal, where I had a colleague who had a client who went in and said, hey, I want to he took out a home equity line, and then he bought Boeing at $180 and then sold it at $160, like 3 days later, because it's super volatile. Now, if you're buying Boeing is a company that lost 70% of its value. I think that company is going to come back. That's just my feeling. I don't know. But if you could have bought it at $90 and then you're trying to sell it at $160, $180, you just doubled your money in like a week, right? That seems great. But you have to be right on both ends, right? So if people are thinking about putting money to work, if you're a long-term investor, it's like you talked about with homes. If you're buying the house for the long term, then yeah, it could be a good time to start exploring some of those opportunities. If you're trying to be a trader, then I don't think, unless you're a professional trader, because you're going up against the MIT endowment fund, the UW endowment fund, these endowment funds, these institutional investors in these hedge funds that have hundreds and hundreds of millions of dollars that they're trading. And so when you try to buy that Boeing stock, if you get on the backside of when they sell it, you bought it and then they sell it, but their big position, it's going to drive down. Just using Boeing as an example, right? Yeah. So if you're a long-term investor, there can be really good opportunities. But if you're going to do that, you got to be prepared for some of these companies that I think that are good to buy, to go down further from here, and then be ready to buy more, right? The idea is if it goes down, if it's something that you believe in, something that that you use, I don't think Microsoft's going anywhere. I think, or Facebook, we're on Facebook Live, right?
Or Zoom.
Zoom, right? Any of those companies, I don't know that they're going anywhere. I haven't done the due diligence to know if they're great companies to buy. But if that's something that you're using and you feel like it's going to be around for the long term, buying it now, when it goes down 10% from here, you should be excited to buy more of it. So if you're not prepared to do that, then I would keep the money in cash for right now and just kind of wait for the market to feel itself out.
So, but there are, I think that one of the other things that I think is interesting about financial planning, choking on nothing, is that I think that these times bring new opportunities, right? So if you think about it, back in 2008, 2009, that's when companies like Uber were created, right? So it's like all these new things. I think that a month ago, well, I can tell you a month ago, my dad's probably watching right now, but my dad didn't know what a Zoom call was, right? And then this morning I hosted a Zoom call with 35 people on it.
Right.
And the truth is that I think that something, and I'm not making a plug here for Zoom. I know nothing. No, yeah. I know nothing about stocks.
I was drinking Aquafina water, but I'm not making a plug for Aquafina.
Right. And so this is where we have to blur out our logo things. That I think that it's one of those that when this is all over and we can go back to our new normal life, I don't think things like Zoom are going somewhere, right? Because I have clients who actually are really enjoying the fact that we're doing so much of our stuff virtually. And so those opportunities that are coming up, I think, are those other things that allow different ways to invest in the market.
Absolutely. I mean, you couldn't. That's a huge point. That I think that when one of the big economists that I follow, his name is Jeffrey Gundlach. So if people want to Google Jeffrey Gundlach, who runs Double Line Capital down in LA. Super smart guy. What he's talked about is that when we go back to whenever that comes, and a lot of analysts are saying third quarter is when the market starts to rebound. Maybe end of the second quarter as they start to digest stuff. They don't know. Nobody knows. But the idea is it's not going to go just because we're going back to work or we're getting back on track because we're coming out the other end of the pandemic. It's not going to be the same as it was before. I don't know if people are following Andrew Cuomo, the New York governor, who's done updates every day. I think that listening to what they're saying about what you're saying about Zoom, about virtual stuff, people are getting, now that they're built for it or set up for it because they were forced to, working from home, I think, is going to be even more prevalent, I think, right? There's going to be, I think, probably DoorDash and Uber Eats and all those things that are, these delivery services, hopefully, are helping keep some restaurants afloat. I think the new normal is going to be totally different than it was before, but it was after 2008. It was after 9/11. You think about all these things that have changed our country over the last however many years. We go through these big things and then the country is different. Our society is different, not necessarily worse, right? If you've seen kind of one of the big positives from this whole awful situation, the radar, visions over China and over LA have been, the pollution level has, dropped immensely because people aren't going out as much, aren't driving as much. The air quality has improved incredibly. And I think those are things that will carry through from something like this, right? People are going
to. So my husband has I half work from home when this isn't happening and half work from an office that I have in Portland. But my husband's been working from home. And it's that very interesting question of how many people will be going back to an office. And if all these offices can survive with their people working from home, the overhead, that might be a cost they choose to reduce, right? So I do think that a lot of this, the opportunities that come, and it's a little off topic, but I think that the opportunities that come from this financially have a lot of upside for a lot of people.
Right.
So, okay. So what are you doing? How are you meeting with people? Because what you have to say is obviously so important for us to hear. How are you meeting with people? What are you doing? He gave me a little tour of his office before we jumped on here live, that there's not another person in the whole office.
Right.
So how are you still connecting with clients? How are you still communicating? What are you doing?
Yeah. So it's a hard thing, especially because, most of my clients, tend towards the, higher risk range for the, from COVID and from the coronavirus. And so we made the switch early on several weeks ago to doing 100% virtual over the phone, or like you said, your dad had never done a Zoom meeting. So that's been harder for some of my clients I use Microsoft Teams because that's how we communicate. Because I have 3 staff members who all work at least semi-remotely, if not 100% remotely. We have voice over internet phones so that I'm able to take the phone to whatever office I'm at. But so most of the time I've been communicating via email, via phone calls, via video chats with clients. When I've had prospective clients that have wanted to come in and meet, we do it via video chat. It's really hard. I mean, very similar to your business. It's really hard to get to know somebody's situation, to get to know clients, to get to know them, because they become friends, become people that you care about. It's hard virtually, at least at first, right? But for right now, that we're just trying to do what we can to stop that spread. So we're doing that. We're going to be launching, a couple of webinars here coming up soon. I've been following up with the CARES Act that just got passed on Friday, which is applicable to a lot of retirees, to small business owners and different things like that, all the different stimulus items that are coming from the government. So we're trying to do that sort of stuff, doing stuff like this. I also do a radio show, which, so we host a radio show every weekend. And so that's part of the way that we, collaborate, get information out to clients.
Okay, so I'm going to write down a note here. I'm going to drop Bo's radio show in the comments so anybody can grab that and listen to that on Saturday mornings. And then, Bo, who did you say that you were following in LA?
Jeffrey Gundlach, so Gundlach.
Okay, I'm going to drop that one in there also. And then I guess my other question for you is a lot about, obviously I'll drop your contact information so people can get in touch with you. I think that I was going to ask what advice would you give your dad, but your dad's in the business too, so you probably wouldn't give your dad a lot of advice.
Well, I give him some advice. He's a CPA, so it's a little different, but yeah.
But he's in the same realm of stuff. He manages money, or he does money and stuff too. Okay, so let's take your mom, who's not in the business. At this time, like, what advice would you be giving your mom? Like, talking about the CARES Act and all of that. Like, what do we do for that? What should we know?
So when you're talking about folks that are in that retirement age, so the CARES Act, if people are at that age or they're talking to their parents about it, there are no required minimum distributions for this year. So most people might know once you hit 72, if you have an IRA or a 401k, you have to take money out of it and pay taxes on it. That part of the CARES Act is they suspended that. I'm telling people if you have folks that are only on Social Security, so they haven't been filing tax returns, they need to file a simple tax return if they want to get that stimulus check from the government that's coming, because it's going based on your tax returns, at least as of now. They're pushing to utilize Social Security reporting, but as of now, the Treasury said you have to file a simple tax return. The big thing is to evaluate your risk tolerance, right? To make sure that you are properly allocated to how much risk that you can take and how much risk that you need to take for your long-term plan. So the biggest thing we go back to, and you talked about being a planner, is if I have a financial plan where I need to earn X amount of dollars and have a certain amount of dollars that's set aside to make sure that I have income for the rest of my life, meeting my goals, that's going to increase with inflation over time, and have play money, then we need to build all that out and do a holistic look at it. And at that point, then you don't need to look at the market, because it doesn't really matter as long as the market or the portion of your money that's invested in the market is doing what fits into that plan. We've planned for this happening for our clients. Now, it doesn't mean I'm happy that the market's going down. I mean, ideally, I'm making clients money every day, all day. But when we're talking about folks that are my mom's age, who she is a client of mine too, right? So I always operate as a fiduciary. The way that I look at that is not just putting my clients' needs first, is making sure I'm not doing anything for any clients that I wouldn't do for my mom. Right.
Right. That's my favorite question to ask people. I mean, and you're doing it for my dad. So I mean, that's. Yeah. But I mean, I love that question when somebody says, "What would you do for your mom?" Because that is who, I would work hardest for my own family.
For your own family, exactly. So the idea is, if you're in that age, you're 5, 10, basically 55 plus. So you're getting close to retirement, then you need to make sure that you're allocated right, that you're allocated for your plan, because the idea is you have to have something long-term that you can stick with, right? And if that, for some people, that's just sticking money under a mattress. I think that's the wrong plan, but that may be, they may have to give up, when they get to retire, they may have to, work longer, they may have to save more, they have to spend less in retirement. But if you can't handle fluctuations in the market at all, then you need to find a plan that incorporates that, working with somebody who's willing to do that rather than fit you in a box. Our clients that are in that super conservative range, the market's down 35%, they're down 10, right? And then even actually their overall holistic plan, they're down 5 if you really count the holistic plan, because we have a certain amount of money that's not at risk for the market. Now, those are those people, right? That's their allocation. The people that are my age and your age that were much younger and growing, we're down a lot more, maybe not 35, but down a lot more because we're taking more risk, right? Because we have time to come back from it. But you have to realize those trade-offs when the market does snap back, which I think it's gonna. Those same sort of people weren't up 30% in 2019, right? The market was up 30% for the year in 2019. And so if you want to get that, you have to be willing to deal with what's happening right now, right? There's no people that are getting 30 on 2019 and losing nothing now. It's sort of, that's the trade-off, right? So when I tell people that are my mom's age that are approaching retirement, or your dad's age that are in retirement, hey, look, what kind of risk profile can you handle, because it needs to be something that we stick with and don't jump off. We need to ride the roller coaster to the end, and we'll get to where we're going.
So when is the best time to start your financial planning?
When you have time. Yesterday. Yeah, as soon as possible. Right. Because people will say, because the question I get a lot is, they say, do you have an account minimum? And we don't necessarily have an account minimum, but at the same time, it has to be worth, our time to work with people. But the idea is you can get, even just going online, if folks are just getting started and they want to go online to Fidelity, has good resources. Wherever their 401k is managed has good resources to at least get a base plan in. But it's sort of like your estate planning. It's you want to do it as soon as you can, because you want to have a plan in place, because then you can reference it, right? And whether that plan is, hey, I'm going to put $50 a month or $100 a month or $250 a month from my paycheck in there. It behooves everyone to sit down and do that as soon as possible, because you want to, if you have a bogey to shoot at, it makes it a lot easier to stick with the plan.
Yeah, I needed a football reference there.
Oh, sorry. Yeah, you need to focus. We're hurting for sports, for sports plan. Yeah, you got to have a game plan, right? So because you want to be proactive and you want to be blitzing the weak side corner, against the spread offense, not doing it because they're doing it, but because you want to blitz.
Okay, good. Okay, that one I get. The other one, I'm like, what sport are we talking? Okay, that is all super helpful. The other thing I was going to ask you was one other question of, so I know that Fidelity and all the big national companies have some good resources. I'm a huge fan of the supporting local, be local. And so I'm going to go out on a limb here and hope I'm right. That you would take a phone call with somebody if they're just starting out and want 15 minutes of your time and to make a plan so that it's longer term. I'm just here. Let me expose you to his calendar and.
No, sure. No,
yes, but I'm a big fan of local. I will tell you a little bit more that I've known Bo's family for how old are our kids now? Almost 7 years. I've known Bo's family for almost 7 years. Bo was born and raised in the Portland metro area. So I mean, this is home. So how do we support, for me, it's about supporting our local families and our local businesses. Sure. So.
Yeah, no, and I definitely appreciate that. And I didn't mean to be like, shooing people away.
Sure, call Fidelity.
I take, so one of the things I say on the radio, and the thing that I let people know is that, there's no stupid question when it comes to your money, when it comes to your estate planning, your tax planning. And I usually, what I tell people a lot of times is advice is free, work costs money, right? So if people want to call and pick my brain about, here's a good place to get started, here's a good place to do all that, I do that all the time. We have no obligation consultations. That's thing offer I make to everybody. They ask, hey, I want to come down and sit down with you and do a plan and do all this and that and the other. And I say, well, the first time we sit down and get to know the process and talk to each other about how that looks, is there's never a fee for doing that. There's never a cost. And then if we decide we want to work together, then there's a cost that we agree upon at that point. Just like working with a real estate professional, or my view is we earn their business, not, we don't
get it. We don't get the business. We have to earn the business.
Right. Exactly. And so the idea is if folks, absolutely, that I think me well enough. If people want to, if there's a 15-minute phone call, if they want, advice on X, Y, and Z, where to get started, how to get started, I'm happy to talk with people about that. It may, depending on, scheduling time, it's, it doesn't mean that I'll take a call right when they call in unless I'm free. If I'm available, great. But otherwise, I'm happy. My staff will set up a time to schedule a phone appointment or schedule a video chat just to kind of go over where people are and how to get started, any of that sort of stuff for sure.
Awesome. Okay, so I'm going to let you go because I promised you I would only keep you away from your clients for half an hour. Sure. So get back to making people some money and at least holding them stable for the moment. Yeah. I appreciate your time. I appreciate you and your family. I'm going to drop a bunch of information down here in the comment section. And if anybody has any questions for Bo about financial planning, definitely reach out. Yeah. I miss you, friend. I miss you. Hey, hug. Yeah, all right. I'll chat with you soon. Thanks, Bo.
Bye-bye.